Today, you're going to be learning about consolidations and basic market structure. These are movements that people frequently tend to neglect. I refer to the basic market structure as the rule of fours. When it comes to consolidations, you've already come across these when I talked about supply and demand zone formations and existence of a base. Consolidation is one of the most basic price action patterns that is incredibly helpful when it comes to real-time trading. Whenever you see a consolidation as a developing price action pattern, it means that the price is having trouble breaking through a particular area for whatever reason. You don't necessarily need to know why the price has stopped moving in the same direction. When it comes to rule of fours, it goes hand in hand with consolidations, as you will see in a minute. Starting with consolidations, what are they? They are a series of candles with similar sized bodies. The actual wicks of the candles don't matter. Think of it like looking at soldiers in a line. One version of the consolidating pattern will create a very flat looking area, much like a rectangle that you can see here. It is a sideways action across at the very least 3 to 4 candles, sometimes a few more, especially if you're working from very low time frames such as a 15-minute or a 5-minute chart. Consolidations can look quite different and can sometimes even be very choppy when it comes to the candle wicks. Or you can have something like this, which is more of a sliding consolidation. So this one actually starts with a weak bearish engulfing and then pauses for the next candle and finally creates another more confident bearish engulfing as the finisher of the pattern, giving you a clear new direction. Here is another similar example. But the main takeaway from all of this is that the candle bodies will not differ much from one another when the consolidation is happening. The bodies of the candles will also be contained in a relatively small range of opening and closing prices. However, all valid consolidations will have some common rules attached. There are 3 reasons why consolidations might occur. Only 2 of these listed ones should matter to you. So here they are. The first one is when price runs into a strong supply-demand zone that has very large orders, and then the price is unable to keep moving in the same direction. This can also be read as the waning momentum. So let's say you have an economic release that comes up with some really good numbers, but the information was somewhat expected. What will happen is that the price will initially whipsaw around a little bit, especially with figures like non-farm payrolls, the infamous NFP. But after about half an hour to 45 minutes, the dust will settle, and that is when you will usually start seeing a consolidation on one of the time frames. I use anything from 5 minutes, 15 and 30-minute charts for something like this, which means that I will sometimes have to wait for about 2 to 3 hours after the release to get my trade. These trades are usually good to keep for at least 24 hours. To date, I have not actually had an NFP where I traded based on consolidation and then that trade failing to work, so it's pretty foolproof. I can generally find my trade in about 2 attempts. On most occasions, if the first trade doesn't work out, I will do a second trade, but it's usually on a different instrument. Whenever that happens, it's most likely because my first choice of a financial instrument is not really moving as I expected it to. Therefore, I have to move on to something else. Now, the second reason could be that the institutional market participants agree on the current price. So this agreement in prices will only be valid when it happens during the active trading hours. So if you see the reason number 3, after hours trading, this is when the major exchanges are closed and you get this random walk price action. It's price moving around, but not really doing much. We've had some traders who have kind of skimmed over this part, so I will keep repeating this. If you insist on trading from lower time frames, check whether the volumes are high or not. I would prefer that you first start with the daily and 4-hour charts, but I know that a lot of you will be staring at 15 minutes, 30 minutes and 1-hour charts, because it's usually very difficult to wean people off low time frames. But if you still want to try and trade from lower time frame consolidations, make sure you check your volumes. These will show you which consolidations were made during the active hours and which ones were out of hours. So if I go to any chart right now, this is the 1-hour chart of USD Mexican peso. If you want to get the volumes on your chart on MetaTrader, you just press Ctrl L, L for Lima, and you get these lines from the broker. Now, they're not really that accurate for any serious volume-based strategies, but what they can tell you is whether the markets were open or not at the time when the consolidation was happening. So if you can see, here's one consolidation. So in order to check whether that was during the active trading hours, you get these volumes. Of course, you have these consolidating candles, but look at the volume here. Like, it's non-existent. So therefore, out of these two, obviously this is the valid consolidation, whereas this one will be invalid because it was created out of hours. And while I'm at it, one note on charting and execution. I use MetaTrader for my charting regardless of where I'm planning to execute my trade. This practice, having a separate charting platform from your execution platform, typically prevents mistakes such as fat finger trades, accidentally moving stop loss levels, or even executing pending orders at market by accident. So I may plan to enter a trade in different products. I might use a Bloomberg terminal to do that, maybe for some option trades, or perhaps CTS T4 for my futures trading. I also have a different MetaTrader platform to execute my spot market trades. In fact, most professional traders have one software for charting and another software for execution of trades. For my own charting purposes, I use an old real account from LCG, from London Capital Group. The reason why I use LCG is because their liquidity provider is based in London, which means when I hover over my charts, the server time will exactly match my own location real time. And to show you that, if I hover over the current 1-hour candle in this USD Mexican peso, you can see that it says it's 11 o'clock at night. So it's the candle for 11 p.m. And if I show you my local time, you will see that indeed we are in the hour of 11 p.m. If your broker, however, is based somewhere else, like in Australia or Cyprus or USA, the broker time on the charts will be markedly different to your real time. In that case, it is a little safer to refer to the volumes instead of the actual times, because it will show you better when the active trading hours were for that particular instrument. Another thing, while I'm on the subject of server broker times, I tend to use 4-hour charts for some of my swing trades, especially if I'm not able to observe the market all the time. For example, I might be out for some meetings. Reason for using the 4-hour chart is because it is the smallest possible time frame that contains enough trading information for the supply and demand zones to work. But it is also small enough, pips-wise or ticks-wise, enabling you to use around 40 to 60 pips stop loss on the levels on average for major forex pairs. The next reason is that the setups taken from a 4-hour chart will come often enough to fall into that shorter term swing trading, where trades will last you anywhere between a day up to about 3 days. This is somewhat a personal preference, but it is also because the market conditions have changed quite a bit. There is a lack of momentum nowadays in 2019 when I'm recording this compared to what it was only about 7 or 8 years ago. If you also intend to trade from the 4-hour charts, try to find a charting broker now this is very important, to find a charting broker where the 4-hour candle starts exactly at 8 a.m. London time, so that the 4-hour chart can align with the start of the London session. The reason why you want to be using a broker whose 4-hour candles align with the London Exchange Open is because unless you have that, you'll be getting an inaccurate supply and demand picture on that 4-hour chart. In fact, that first hour of active trading creates something called initial balance range that I teach in my market profile courses. Market profile helps you to get an X-ray into market participants intraday. So it gives you like an additional view into what is actually happening with order flow as well. So then if you get a 4-hour candle that's mixed in inactive hours with the active hours of London, you'll be getting a very messed up supply and demand picture. So you'll be getting the wrong levels. You cannot trade from that. And every time I have a new student, they all think it's complete nonsense until such time that I obtain an accurate entry from my 4-hour charts that's not even visible on theirs. So trust me on this, you're going to save yourself a lot of trouble down the line. Anyways, back to consolidations. So if you see consolidations on lower time frames, including 1 hour, 30 minutes, 15 minutes, and 5 minutes, you must ensure that these are created during the active hours. Those that are created during the inactive hours will automatically be invalid. Once again, why is this? It's because they were created by lack of trading activity. When it comes to out of hours, market participants with deep pockets that we need to follow when it comes to moving the markets, they're not at their trading desk. They are in a pub or in a strip club. Bottom line is, they're not trading out of hours, so neither should you. If you have a position open already, you can keep it, but please do not open new positions if that particular instrument does not belong to a particular exchange. Okay, next up, looking at a basic market structure. I call this the rule of fours. So let's have a look at what is this rule exactly. Here's the big secret. There are only 4 phases of market movement. And it's completely irrelevant whether it's an uptrend or a downtrend. They're still the same 4 phases. So there's phase 1, referred to as accumulation. There's phase 2, also known as the markup. Phase 3 is called distribution, and phase 4 is called liquidation. So if I take any chart at all, these 4 phases will always be present. Now you will notice that accumulation and distribution look very much like a sideways movement. And for our trading purposes, what is a sideways movement? It's a consolidation. So here's an actual chart. You can see there's accumulation, so phase 1, then you have a move up, which is a markup, then you have distribution, so another ranged area, and then liquidation, which is a down move. Some of you will say, well, this is an example of an uptrend. How does this work in a downtrend? Here is how. Accumulation, markup, distribution, liquidation. Okay, so you have phase 1, phase 2, phase 3, phase 4. So this repeats over and over on any chart that you can possibly find. So by using a consolidation to recognize phase 1 and phase 3, accumulation and distribution, it gives you a great accuracy over speculating what kind of a move may come next. And again, it's completely irrelevant whether it's a downtrend or an uptrend. This is why it's important to know what your consolidations look like, because they are the ones that will give you information about which probable phase is coming next. For the purposes of trading and trading entries, there is a bit of difference between an actual consolidating pattern and phase 1/phase 3. When it comes to executing trade entries, consolidations absolutely must contain uniform candle bodies. Candle bodies must be of similar size. So I'm going to emphasize once again, this is solely for the purpose of trade entries. Phase 1 or phase 3, on the other hand, they can be a more of a messy sideways movement. It doesn't have to be equal sized bodies necessarily. And phase 1 and phase 3 can also carry on for quite a bit longer than the consolidation pattern. The reason for this is that consolidations will be used for your actual trade entry executions. Ideally, a consolidation pattern needs to have a strong engulfing finisher candle, like we've seen in one of those examples. This candle tells you that the opposing side has confidently taken control, thereby resolving the equilibrium that you noticed beforehand. So this engulfing finisher candle is your trigger for your trade entry. Sometimes you might be able to enter a trade even without the engulfing finisher, but this needs to be combined with other confluences such as market profile, TPO structure on the day, and a whole bunch of other things. If you happen to come across a messy version of phase 1 and phase 3 rather than the uniform candles, these can also still be very useful, but only for speculative purposes, only for speculation on the next direction. You wouldn't have an exact trade entry price in that case. This way of looking at phase 1 and phase 3 is incredibly useful for the creation of your trading plans. So if you see the messy phase 1 or phase 3 on the daily chart, you know that at some point there is about a 90% chance that a markup or liquidation is coming next. So phase 2 or phase 4. And that's basically half of your work done. You have your direction. All you will need after that is a definitive, clean price action pattern to give you your trade entry price. I mentioned consolidation patterns and the messy phase 1 or phase 3, but I can appreciate that these two can actually look quite similar at times. It can be very difficult to delineate between the two formations. For example, here's a chart where it really looks like this is a consolidation. You have these uniform candle bodies, seemingly. But this is actually a phase 3. You might be wondering why. I said before that consolidation will have an established range of open and close prices in a small range. One thing that you need to check when you're trying to determine whether a formation is a true consolidation or a phase 1 or phase 3 is to see whether any of the subsequent candles are closing further with the old price direction. So in this case, it would be further up. If you look closely on this chart, the initial open close range was established by this little evening star formation. So you had this one move, then this little doji, and this attempt at a very weak bearish engulfing. So these are your candles that have established that open close range, in particular these two. So the next white candle, this one here, it creates a little bullish engulfing where the price actually closes higher than these two. So it breaks that previously established open close range that we need for the consolidation. So for trade entries, you do not want to see this, which is why this structure is a phase 3 and it is not a true consolidation. Sure, it works out eventually, but in vast majority of cases when you see this, this will be a redistribution and the price will keep shooting up. Here is an example of a true consolidation based on this rule. So you see there's lots of rejection wicks. But let's have a close look at this open close range. So you had something that went up, then you have this black candle that stopped the whole move. Well, this candle establishes that range, further reinforced by the fact that the next candle didn't really go much higher. None of the subsequent candles break the open close range that was established by this first black candle. So this is a true consolidation. And this is another example of a pattern that looks like it is a consolidation, but it's actually a redistribution. So here you have something that has uniform candle bodies. So on first glance, you're like, well, yeah, this is a consolidation, 100%. But then let's go a little bit deeper. Where is the established open-close range? Well, it was established by these two candles, okay? Subsequent candles keep pushing ever so slightly higher, meaning that they're breaking this range. This is not an equilibrium. This is not an agreement in price, in spite of the uniform candle bodies. Whenever you come across something that is a bit ambiguous, you need a clear break of the entire area, either side. So either with one really strong upwards candle, so another clear bullish candle, or a confident reversal candle that would need to close below this entire area. So I mentioned redistribution, reaccumulation. Well, in short, it means that the prices stop and pause for a little while and then continue in the same direction, which is why it's called redistribution. This is where Q points come into play. If you're expecting the price to keep going towards a Q point, then maybe this particular phase 3 in the middle of nowhere is probably not going to mean that liquidation is going to come, that phase 4 is coming. But instead, it's more likely to call this a redistribution. So you'd be expecting another markup, another upward move. And that move will be shown to you by the ways of that confident upwards candle. That would signal that the move is not done yet and the market is simply taking a breather before continuing in the same direction. You also need to check higher time frames. Anytime you're in doubt about something or things don't really make sense to you or they don't look clear, keep going up the time frames. Likewise, if things are looking really messy on higher time frames, which can happen sometimes, keep dropping down to lower time frames until you can get some more sense out of it. If you cannot find either of these, you should not be trading that instrument. The whole point of the market stalkers method is to combine all of these enhancers that will systematically give you very few areas that are tradable under very similar conditions. So just because there's a supply or demand area, it doesn't mean that you should trade it. A position of a zone within an established swing can also make the zone weak, okay, no matter how strong the zone may look. For example, if the zone is in the middle of nowhere and you don't have Q points established, that zone will be weakened by its location within the previously established swing. Now, I say that you will only be able to find very few tradable areas, but that doesn't mean that you won't be able to find enough entries. If you carry on studying with us in level 2, you will learn about market profile, which gives you a couple of entries on most instruments in any single day. So you have to be careful not to overtrade if that's your end goal, to be a day trader. Your homework is once again to go to your charting platform and to look at your charts, trying to find these 4 phases of market movement. So practice finding these phases on loads of examples and on loads of time frames to get comfortable with the technique before you start applying it. Now that I've been through most of the supply and demand rules, I would like to set the scene in regards to trading weak zones through confirmation entries, which is something that is coming up and is explained in depth across 3 different lessons. Now, the market stalker's way of confirmation entries is very different and a lot more effective than your traditional confirmation entry that will typically give you a really unfavorable trade location with a huge stop loss. Okay, so we're not going to be doing that. We trade confirmations through developing price action, either using the engulfing patterns, but even more frequently using these consolidating patterns. Let's say you have a weak demand zone that is located inside a low Q point. So you have this extra piece of information that the price is coming to an extreme of the swing, and you want to start looking for your rejections to get your long trade. But things are a little bit ambiguous on the supply and demand front. You might have a normal formation zone, let's say on the daily chart, and then you try zooming in to see whether you can find a strong zone on a 4-hour chart, but there's no strong zones. So if you decide to enter a trade, yes, it might work, but you know the probability is likely against you. You shouldn't be placing a limit order there. I typically like to wait and see what the price will do once it arrives at the level. I want to look for developing price action. Now I had this scenario in Euro-Yen. This is a daily chart. So after an extended downtrend, duration-wise, it went on for an absolute age. I actually noticed that the price was finally reaching a daily demand area, but it was weak. However, it was inside a daily Q point. So I waited to see, once the price got here, to see whether there would be some kind of a consolidation. I wasn't prepared to trade from this bullish engulfing because it was such a strong downtrend. So I waited and waited, and then it became obvious that there's an accumulation phase going on. And that's another difference between consolidation and accumulation. So accumulation can go on for extended periods of time, but it's still accumulation. I knew what was coming, okay? But still, this was a very painful trade. But let me show you a better one that didn't actually take as long. This is a euro-dollar on a 4-hour chart. So the 4-hour chart had this weak-ish zone. It had a good profit margin, but it has acted as support previously. So when the price came back to it, I really needed that confirmation trade. I needed to see whether another bounce may happen from it. Obviously, I'm using Blatek supply and demand. This is a backtest mode, so you can see what the level looked like at the time of price arriving there. And there's a way to switch on multiple time frame zones, meaning that if you want to keep an eye on the higher time frame zone, but you still want to explore the lower time frames, like 30-minute chart, for example, as I frequently do. All this can be done at a click of a button. So rather than painfully drawing things manually for yourself and switching back and forth between the time frames like a madman, it's all done literally by pressing a couple of buttons. So this is what I have here. I have my 4-hour zones displayed, but I'm exploring a 30-minute chart. Now, what I was looking for was this consolidation here. After the price consolidated for about 4 candles, I had a good indication that the price is having trouble breaking through this area and that I might indeed get another bounce up. I also used market profile for this to have an additional X-ray into institutional traders intraday. Once I saw the consolidation at the right time of day, I entered my trade and I placed my stop loss under the low of this consolidation. If you look at it from another perspective, this consolidation can also be looked at as a new demand getting created. So it's an offspring zone. They overlap the parental originating areas. But they are truly excellent when you trade them from developing price action consolidations that you notice in real time over the course of the trading day. And that is how market stalkers trade confirmations. This is all explained in even more detail in 3 additional lessons as a way to trade supply and demand in a more advanced way. You still have to know which zones to choose as your trade locations, because most weak zones won't be enough to stop the price breaking through them. But those weak areas at the tops and bottoms of the swing extremes of Q points, they're excellent for these types of rejection confirmation trades. So look out for these. I frequently use this technique on my intraday trades, but also on swing trade entries using a 4-hour chart. So you're looking for either consolidations or for phase 1 or phase 3, as was the case in that Euro-Yen trade that I showed you earlier. Now it's time to start practicing applying these rules of consolidation and basic market phases with developing price action. Both of these will help you greatly to find future market direction with ease.